सखा त्वमेव त्वमेव विद्या द्रविणं त्वमेव त्वमेव सर्वं मम देव देव कायेन वाचा मनसेन्द्रिये वा बुद्ध्यात्मना वा प्रकृति स्वभावा करोमि यद्यत् सकलं परस्मै नारायणायेति समर्पयामि नारायणायेति समर्पयामि गुरु ब्रह्मा गुरु विष्णु गुरुर्देवो महेश्वर गुरु साक्षात् परब्रह्म तस्मै श्री गुरुवे नमः तस्मै श्री गुरुवे नमः ॐ सहना भवतु सहना भुनक्तु सह वीर्यं करवावहै तेजस्विनावधीतमस्तु मा विद्विषावहै ॐ शान्ति शान्ति शान्तिः सर्वने जय श्री कृष्ण.
Thank you, Bas. Sarvane Jai Shri Krishna. And before we start, again, we remind there's still time. If you think today's topic, a very, very important topic on how to maximize your tax allowance before the end of the tax year, before the 5th of April, please share the link. Koine પણ તમને યાદ આવે કે oh, I can still quickly pick up a call. Do so now, please. જેવી રીતે પણ આપણે મદદરૂપ થઈ શકે, we have to try and help. So please share the link or make that phone call now. Still 2-3 minutes. So whatever way we can help, it is a very, very important topic that Dipesh Bhai is going to share the presentation and everything. So Sarvane, Jai Shri Krishna, Jai Jinendra.
Jai Jinendra.
Over to Dipesh Bhai.
Oh, thank you. Jai Jinendra and Jai Shri Krishna. Hello, Ba. Kim Shotame. So yeah, let me start the presentation. I'll start share screen. Hopefully everyone can see that. Let's just go into presentation mode. Oh yeah, perfect. Okay, so welcome to today's presentation. Today's presentation is a very interesting one. It's the right time to have this presentation coming up to the end of the tax year. There's actually not that long to go. There's only 48 days to go before the end of the current tax year, 5th of April. So less than 7 weeks, and the next 5, 6, 7 weeks will of course go by very, very quickly. So this is the ideal time to start thinking about your tax year-end planning and making sure that you're making the most of the available allowances, which will benefit you. A lot of the allowances have to be used by the 5th of April 2023, and a lot of the allowances work on a use them or lose them basis. So if you don't use the allowances, a lot of these things you will not be able to use the following year. So in terms of this presentation, I'll give you some background about myself, what I do, how I help clients. So I've been advising in financial services since 2005. So over 15, 16 years of industry experience. I've been running my company, Oakdale Financial Services, since the last 10 years, since 2011. And so I've got 15, 16 years of experience of helping clients. The key thing I enjoy is being able to help clients with their financial planning, all areas of financial planning, so tax planning, investments, retirement, inheritance tax, all of the sort of things that we need to think about, we should think about, but sometimes it's not always at the top of everyone's list of priorities. There's lots of other things happening, but it's so important that as much of your planning is done as early as possible. So in terms of in terms of my role, so my role is really to understand the client situation, understand your personal and your business life, and what's really important for you. So what are your goals? What are you trying to do? And then it's a case of making sure we put together the right plan to allow you to achieve your goals. So we need to understand the situation, and this will include what assets you currently have, what you expect to have in the future. So some money might come from inheritance, some money might come from savings, sale of a business, etc. And the next step, a part of the plan, is how you use and intend to use those assets. So what's the long-term plan for those assets? Making sure that you've got enough money to last for as long as you're alive. And we know that financial planning is becoming more and more complex. There's a range of lots of different types of solutions out there. There's lots of different tax considerations that we need to take into account. We need to understand which solution is going to be best for you, your family, in your particular set of circumstances. So one thing is not going to be right for everybody. And we understand that legislations, the government rules, priorities can change. And therefore, what we do with all the clients is we review circumstances regularly just to make sure that your planning is on track so that we can deliver the right financial outcomes for you. So my experience, my expertise is understanding financial planning, understanding tax, and also understanding what the client's plans are, what the client's dreams, goals, and objectives are, and what they're trying to do. And what I do is I bring the two together and put together a plan that will help you both now and in the future. So, like I said, there's not long to go before the end of the tax year. We don't like to just let the allowances go to waste, because these are valuable allowances. We do pay a lot of money in the UK in terms of tax. So I think it's vitally important that we try and maximize all the advantages of tax allowances. So at the moment, it's not too late to maximize these allowances. Like I said, there's 48 days to go. Less than 7 weeks, which will go by very fast. Obviously, it's important to take the right advice and put in place the right actions. This will help you in terms of your financial future, your financial goals, your financial well-being. So the key thing is, in terms of your financial future, the key thing is making sure we're finding the right balance between how you save your money, how you invest your money, how much, and we combine that with clever tax efficient strategies that you should be maximizing, you should be using to make the most of your money, your wealth, and of course your assets. So whatever your plans are, whatever is important to you, I'm able to help you make sure you get the most out of the allowances. And we need to do this before the 5th of April 2023. And also right now, the world is becoming more and more uncertain. So therefore, the need for advice is even more. So just if we have a look back at some of the things that have happened in the markets over the last year or so, since beginning of 2022, we've had global concerns about interest rates, inflation, high rates of inflation, where things are becoming a lot more expensive. You've got the Russia-Ukraine situation, which is still, of course, ongoing as well. You've had energy prices go up. The Russia-Ukraine situation has created more shortages. A lot of things like oil and other things comes from that part of the world. And obviously that creates shortages in products that are available. That pushes the price up. So there's been a whole range of things that have happened in the world last year. And wherever people invested the money last year, whether it was into equities or corporate bonds or property, gilts, all of those things went down in value. It was an unusual year where everything went down. Now, although assets have gone down in value, that's not a bad position, because ultimately that gives you an opportunity to buy good quality companies at a reduced price. So think of it as a sale is taking place, prices have dropped, and you're still able to purchase good quality companies at a reduced price. So yeah, certainly makes sense from that point of view. So now we'll have a look at which financial goals are most important to you. So different people will have different requirements depending on what stage of life you're at. So you might be at the early stages and you're thinking about building a foundation. So what does a foundation look like? So maybe you're thinking about savings for the first time. Maybe you're thinking about investing, building up funds, maybe buying your first home as well. And you might also be thinking for planning for a family. So what we're saying is with financial planning, the earlier you start thinking about these things, the better it's going to be, because the longer you have to invest the money, the better it's going to be. It's got more time to grow. The next stage might be secure your and your family's financial future. So you may already have some investments. It's a case of making sure that we're making the most of your investments in terms of how they're performing, looking at the way they're structured from a tax point of view. We might also be thinking about helping your children in the future. So you could do junior ISAs for them. You could do pension for children. This is all thinking about the next generation, putting things to one side, and also thinking about making sure you've got sufficient money for your own comfortable retirement. And the way you do that is, of course, we should be looking at putting money into a pension because of the tax advantages they give you. And if you've done all of these things, then of course it will help you to retire in style. You're able to have the lifestyle you want. If you think what it is you want to be able to do at the point in retirement, you have to plan all of these things in advance, 20, 30, 40, 50, 45, 50 years in advance. The more planning we do, the better it's going to be. So we want you to be able to enjoy life to the max. Even if you're not quite there yet, we still want to start thinking about these. Of course, making sure you do not run out of money during retirement is vitally important, because people are living longer. Life expectancy is increasing because people are looking after their health. Medical science has improved. I'm sure RPM have great speakers on nutrition, diet, fitness, all of that sort of stuff. So there's all of those things. So people are more aware of these things. And certainly, there's lots of options available to you at the point of retirement. And then it's about passing on your wealth. So we're talking about in terms of from an inheritance tax point of view. You might want to help your family avoid paying too much tax. You've paid tax during your lifetime, all the way throughout lifetime. We don't want to end up paying more tax at the point of inheritance tax. You want to give your loved ones a good start in life. So we're helping the next generations. And those are all the different types of plans, the different types of scenarios that we're trying to advise clients on. And the key thing is we can advise you across all of these areas, put together a really good plan for you, and make sure that you're making the most of the available opportunities. We don't like to waste any of the allowances. So why you should invest into an ISA? First of all, it's flexible, tax efficient savings. So ISAs are great because it allows you to achieve your short-term and of course your long-term goals. Everything you put into an ISA is free from income tax, capital gains tax, and dividend tax. So ISA is incredibly tax attractive vehicle, and everybody has a £20,000 allowance every single year. Now, if you don't use that £20,000, it will then be wasted. So you should, where possible, try and make use of as much of that allowance as possible. So everyone has a £20,000 allowance. You can invest in a cash ISA. You can invest in an investment ISA. There's different types of ISAs out there. Cash ISAs might be more suitable for short-term keeping your money there. If you're thinking of keep investing the money, or you're thinking that money is going to be there for 5 years, then of course the investment ISA would usually make more sense. So we're looking at keeping ahead of inflation. So currently the Bank of England base rate is 4%. The rate of inflation is currently 10%. So that means that the cost of living is more than the returns you're making on a cash ISA. So, or just leaving money in a bank account. So what we're saying is if you invest or just leave your money in a cash ISA, it means that your money is going to lose value in real terms. So let's say, for example, inflation is 10%, interest rate, you're getting a rate of, let's say, 3% on your account. And that means you're losing 7% on your money. Now, that's a lot of money. That's a lot of money. So if you've got £100,000 in the account, your money in real terms is going to be worth £93,000 because of cost of inflation, cost of living. So we need to make sure that your money is being invested in the right way. So then it talks about investing in a stocks and shares ISA over a long term means that the growth will be inflation over time. Right now, we've got unusually high inflation. We don't expect this inflation to stay at the current levels for a very long time. Yes, the interest rates have gone up. We're starting to see inflation come down. Later on this year, we'll probably see it come down a bit more. So investing into an ISA, even if you're just putting in a small amount every year, it does make a massive difference. It's just purely because you're putting money in, you're going to have growth, and we're talking about compounding. So the longer you leave the investment for, the better the compounding will be. So therefore, even adding small amounts to your ISA every year, religiously every year, will always make a big difference in the long run. The figure shows how investing £5,000 annually into stocks and shares ISA, the value of your money grows by, of course, reinvesting returns. And the key thing is, with any returns, any profits you make on money in an ISA, you won't end up paying tax on interest or profits. So you effectively get to keep more of your money. Okay. So in this example, if you put in £5,000 every year, at the end of 5 years, you would have contributed £25,000. Based on growth rate assumptions of 2.4%, it could be worth £26,858. If you've put in £10,000, if you put in £5,000 a year over 10 years, that means you've put in £50,000, and it could be worth £57,000. And over the longer term, 20 years, you put in £5,000 a year, £100,000 over 20 years, and that could be worth 129,480. So that's quite nice in terms of return. Obviously, this is based on 2.4%. If the markets grow at more, then the return would be slightly higher. Invest in an ISA. So help give your children a good start in life. Junior ISAs must be started by the parents or guardians. So they're the only people that can set it up. Once it's been set up by the parents or guardian, anyone can contribute to the children's ISAs, JISAs. So, for example, grandparents can contribute. Other family members could contribute. Now, just like adult ISAs, children's ISAs are very tax efficient from an income tax point of view, from a capital gains tax point of view, and you also get the cash ISA or you get the investment ISA. Of course, if your children are very young, they can't get access to this money till the age of 16 for a cash ISA and age 18 for an investment ISA. So if they're very young, it probably doesn't make sense to leave it in a cash ISA because you're going to lose out on a lot of potential growth over that time period. So money can be saved tax efficiently for children up to the age of 18. And again, it's a good way to invest your money, get it outside of your estate, and help to reduce the value of your estate from an inheritance tax point of view. So there's multiple benefits of why you should invest into a junior ISA for children. Here we're looking at your tax allowances for the remainder of this tax year up till the 5th of April 2023. £20,000 you can put into an ISA per person. For a couple, it's currently £40,000, and children can put in £9,000 into a JISA. All ISAs, JISAs are free of income tax, capital gains tax, and dividend tax. So you don't pay taxes on interest, withdrawal, or profits. So again, really tax efficient way of protecting your money. And that, again, is one of these benefits. If you don't use it, you're going to end up losing it. You can't put that in the following tax year. So now we look at personal savings allowance. It's all about being smart with your money. The personal savings allowance, the PSA, means that there's no tax on some of the interest earned on savings in cash savings accounts. So you're allowed to earn a certain amount before you need to pay tax on it. So it's tax-free if you're within the allowance. Of course, we have seen interest rates rise. So that means it's more likely your savings will be subject to tax, especially if you're a higher rate taxpayer. So before, when the interest rates were lower, you needed to have a lot of money in your bank account before you would end up paying tax on it. Now, which I'll show you on the next slide, because of the interest rates have gone up, you actually don't need to have so much in your accounts before you end up paying tax, before you start exceeding these personal savings allowance. Of course, it's important to have an emergency fund in cash that you can access quickly. So always good to have some liquidity, cash-based money that's available, but you shouldn't put all of your money in cash. In the same way, you shouldn't put all of your money into stocks and shares because they can lose value in the short term. But if you invest for the medium term, 5 years, we'd expect to see a return there. For longer term goals, if you're thinking about these other things like buying a property, getting married, or helping the children in the future, all of these things, a stocks and shares ISA will help deliver better longer term capital growth. And that capital growth is important because things will cost more in the future just because of inflation. Some other factors as well would come into play. So we need to make sure that your money is growing as well. So with the personal savings allowance, it means that you might not need to hold it in a cash ISA to avoid paying tax on interest. So what we're saying is you could actually utilize your allowance more effectively by using an investment ISA, which has greater potential for long-term growth. So let's have a look at the personal savings allowance. Based on the rates being a lot higher now, here's how much you could hold in an easy access cash account before you would end up paying tax on the interest. So if you're a basic rate taxpayer, that figure is £40,000. And if you're a high rate taxpayer, if you've got more than £20,000 in your account, that's when you're going to be subject to tax on that money. So personal savings allowance, there's different amounts for different tax brackets. So if you're a basic rate taxpayer, you can get up to £1,000 per year per person as interest without paying interest, so tax-free interest. For high rate taxpayers, you can get £500 of tax-free interest, and for additional rate taxpayers, i.e. the ones that pay 45%, there is no personal savings allowance. Now, one of the things that we have to always be careful of, and it's one that catches clients out quite regularly, is the 60% tax trap. So what happens is, if you earn less than £100,000 per year, the first 12,570 of that is free from income tax for most people. However, earnings between 100, so what happens in the UK, between 12,000, between 0 and 12,500, there's no tax. Then between 12,500 and £50,000, you would pay basic rate of tax. And anything above £50,000, you would pay high rate tax at 40%. Then you get to this £100,000 to £125,000, where you effectively pay tax at a rate of 60%. And then anything above 125,100, anything over 125,140 is then taxed at 40%. Anything over £150,000 then attracts 45% rate of tax. Now, so if your earnings are above £100,000, you'd be taxed at a rate of 60%. So any earnings between 100,000 and 125,140 will be taxed at 60%. This is how it works. So if your income is £100,000 and you get a pay rise or you get a bonus of £10,000, then on that £10,000, you'll pay 40%, which will be £4,000. You'll also lose your personal allowance. So because your income is £10,000 above 100,000, you would lose £5,000 of personal allowance. So that means that's going to cost you at a rate of 40%. It's going to cost you another £2,000. So that gives you a total of 60% income tax paid. So on the £10,000, you will pay income tax of £6,000, 60%. And £4,000 will come to you. So the government is actually, or the HMRC, is going to be the main beneficiary of this income. Now, one of the key things that you can do to avoid paying this trap is put any earnings over £100,000 into your pension. The key benefits of this is you'll save the 60% because you'll get back your personal allowance. So instead of paying 60%, you'll end up paying tax at 40%. And then you've also going to be getting tax relief on your pension contribution of 40%. So let's say, for example, you put into a pension £8,000 as a lump sum. You'll get £2,000 back straight away. So that means the value of your pension is going to be £10,000, and you're going to also claim back another £2,000 through self-assessment. So that will cost you £6,000, but it will give you a pension value of £10,000. You'll also have the benefit of saving the 60% when your income goes above £100,000. So you can see that the advantages are numerous by doing this. So don't forget, in the 2023-2024 tax year, so from the 6th of April this year, more people will be affected as earnings rise, but income tax thresholds are frozen or reduced. So from 6th of April, if you're earning over 125,140, that will be taxed at 45%. Currently, that bracket is being taxed at 40%, up to £150,000. So it means more people will end up paying more tax at a lower level of income. So we need to keep an eye on that, make sure that you're not falling foul of these things. Of course, pensions are extremely important tool for a happy retirement. Money you put into a pension will help you with your retirement. And it's one of the best ways to save for your retirement, purely because of the income tax reliefs that I've mentioned so far, and also because of the fact that you're going to save personal savings allowance. But yeah, for all taxpayers, it's very good. Basic rate, higher rate, or additional rate taxpayers. This tax year, you can pay up to a maximum of £40,000 or into a pension, or 100% of your salary, whichever is lower. And here it's showing you how pension contributions work and tax relief works. If you're a basic rate taxpayer, you put in £80, government will give you £20, so that makes up the £100. If you're a high rate taxpayer, to get £100 in your pension pot, you'll pay 60, and your tax relief will be £40. And if you're a additional rate taxpayer, i.e. 45%, then to get £100 in your pension pot will only cost you £55. So here what we're saying is put what you can into your pension now. Start saving as early as possible. The earlier you save, the better the returns will be, because you're benefiting from tax efficiency. You're maximizing compounding, i.e. compound growth on top of compounding is a very powerful formula. And you should top up as much as you can before tax year end. So before 5th of April, you should be putting money into a pension if you're not already doing so. If you're already putting money into a pension, you should be looking at if that's the maximum you can put in. And if you've got some surplus cash, you should be putting it into a pension, or you may wish to put it into an ISA. Obviously, some different considerations between pension and ISA. In this example, we're saying that if you're planning to retire when you're 67 and you make gross contributions towards your pension of £200 per year, that would mean if you start saving at age 30, at the age of 67, you could have £349,000. If you start at 30, so if you start at 20, your figure could be 349,000. If you start saving at 30, the figure could be £215,000. And if you delay it and you leave it to the age of 40, then your projected retirement funds might be £123,000. What we're saying is the earlier you start saving, the better it's going to be. Invest into a pension. So how much to save for a comfortable retirement? We'll have a look at this on the next slide, and it will, of course, depend on the level of income required, the value of your pension pot you need to achieve your goal, and it assumes you're entitled to full state pension, which is just under £10,000 per year currently. So if you invest into a pension and you achieve the minimum, then it will give you a basic sort of lifestyle. If you get to a moderate level of pension, it could pay for a little bit more. And if you get to a comfortable, obviously that gives you a lot more comfortable retirement when you get to retirement age. So when you invest in pension, your allowances are for the current tax year. You can take out 25% tax-free cash at the age of 55 or 57 from 2028. You can make use of unused pension allowances from previous tax years. So if you haven't used it for 1920, you have to use that first. You have to use the current year first, then you go back to the 3 earlier years. So 1920, 2021, 21-22. You have to do it in that order. So carry forward allows you to put more contribution into your pension. And the lifetime allowance is currently frozen at 1,073,100. It's frozen until April 2028, and it only affects a small proportion of the population. We're also looking at inheritance tax planning, where we talk about protecting your family assets, your family wealth. So there's a very high rate of tax, inheritance tax. Anyone over with assets, as a single person, assets over £500,000, they're going to end up paying tax. For a couple, it's usually £1 million. So here it talks about the minimum tax-free threshold, which is also known as the nil rate band for every individual in the UK, and that's currently frozen at £325,000. So every individual has this allowance. After your allowance of 325, the rest of the estate is taxed at up to 40%. So in this example, the value of the estate is 1.5 million. It's a single person, 325,000 allowance, minus the allowance of 325. That means inheritance tax bill would be £470,000. Now, of course, this could have been avoided by doing some planning along the way. Making the most of your tax-free gifting allowances. So for every year, you could give away £3,000 annual allowance. You could put it into your children's junior ISA. You could put it into a pension for you or your children or your grandchildren. And these are ways of using up your annual allowance. So you could put in £3,000, give it away every year, get it outside of your estate. If it's husband and wife, two of you, you could give away £6,000. And if it's a husband and wife and you haven't done anything in the previous tax year, you could give away £12,000. Now, of course, all of these amounts that you give away will be outside of your estate straight away. So inheritance tax planning, no tax to pay if you leave your estate to your spouse. First £325,000 is available tax-free and is frozen until April 2028 for every individual. So more and more people are going to get affected by inheritance tax. The tax-free threshold increases to 500, and this is if you include your main residence and your assets are going to your children in the future, and as long as your estate is worth less than £2 million. If your estate is over £2 million, you start losing some of your allowances. And if you've got the full 1 million, that's £1 million that can be passed on to your family before any tax. So really important to make sure you're using up all of these allowances. Capital gains tax. Now, again, there's a capital gains tax trap that you might want to avoid getting caught up in. Let's say you're given some shares worth 5,000. They've increased in value and they've gone up to £25,000. That means the gain that you've made is £20,000. And if you tax all of them, the amount of so you'd have to pay tax on the remainder of 7,700. And if you're a high rate taxpayer, then obviously the tax would be £1,540. So we have to look at ways to make sure that you're not paying capital gains tax unnecessarily. So capital gains tax, don't get caught. There's a few things that you can do to help to reduce your capital gains tax bill to zero. You could hold your shares in an ISA. Any gains are then going to be subject from capital gains tax. You could realize 12,300 of the gains from the start from shares this year, and you could do that by the 5th of April 2023, and the rest you could do it on the 6th of April or over the next tax year. You could also consider transferring your assets to your spouse, and this will help you to make sure you're making the most of your joint allowances. So then it's all about making sure we're using the right tax brackets. Here we talk about dividends. So dividends are your returns from investments in companies. Cost of dividend for a basic rate taxpayer is 8.75%. For a high rate taxpayer, it's 33.75%. And for additional rate, it's 39.35%. So let's say you receive £5,000 in dividends. That's going to be taxable at £3,000, and you'd end up paying tax on 975. Of course, if your dividend paying company's shares are in an ISA, then you're not going to pay any income tax on this money. The dividend allowance that was introduced this year was where dividend tax increased by 1.25% across the board. So basic rate, higher rate, and additional rate taxpayers became more expensive. From 6th of April 2023, the dividend allowance will be cut to £1,000 and then to £500 in tax year. It's worthwhile to ensure that your dividends are in a tax efficient wrapper, i.e. think about ISA or pension. This brings us up to the tax year end checklist, things that you can do, things that you should do. If you haven't done it, it's not too late. Make sure that you make a maximum advantage of these allowances. You could utilize your ICE allowance as much as £20,000 in the current tax year. You can also do it for your spouse, another £20,000, and you could put £9,000 per child into junior ISAs. It's tax efficient. You could consider investing into your pension. Okay, so again, that's worthwhile doing for the tax benefits that I've mentioned so far. If you're coming up to your retirement and you need a large withdrawal, then obviously if you speak to us about spreading the withdrawal over 2 or more years, this will help to reduce your tax liability, make it more efficient. And then take advantage of your capital gains tax exemption of 12,300. So it allows you to take full use of these things. If you're a high rate taxpayer, you can bring your taxable income down by putting money in your pension, as we said, or you can make charitable donations. This can bring your home down below the income rate tax bracket of 150. It helps you hold on to your personal allowance and help you hold on to your child benefit. You can give away your annual allowance, £3,000. It's not in your estate. There's no 7-year rule. If you own a business, consider taking a dividend income instead of salary. The first £2,000 of dividend income is tax-free. Whereas in the future, from 6th of April 2023, the dividend allowance will reduce to £1,000. That's how much you can take out from the company before you need to pay tax. So we're here to help you. We can certainly guide you through the complex situation that is financial services. Legislation is another complex area. We can help make sure that you're using the right tax efficient building blocks to help you create the future you want and make it as tax efficient as possible as well. We can help you make the most of your available tax reliefs and allowances. And if you wish to do this, please get in touch before 5th of April. Obviously, that deadline is not far away. My contact details, I can be contacted on my phone, my mobile, which is 07960568644. And my contact number is 0208 150 7565. You can also get hold of me by email at dipesh.shah@sjpp.co.uk. That's everything for my presentation. Thank you for listening, and I hope you enjoyed it.
Thank you very much, Dipesh. If you want to keep that screen there for a little while, while we answer some questions. You can hear me?
Yeah.
Okay, brilliant. Thank you very much. Right. We had please कोई ने questions होए तो please chat ઉપર questions મૂકજો so I can relay them back to Dipesh bhai. So we have, I don't know whether they're questions or comments really from Naina Ben. So the first one says, why has the FTSE just reached record highs despite the bad news and all that? So, I mean, I don't know whether you can answer, you can't answer.
Yeah, of course. So the FTSE has reached record highs. So earlier, yesterday, the figure hit £8,000. Now, 8,000, not £8,000, a value index of 8,000. Now, the reason why the FTSE has gone up, although there's bad news, that doesn't stop the markets from going up in value. So how it works is all this bad news at the moment, inflation, interest rates, Russia, Ukraine, food shortages, energy prices, that's all old stuff that's already been factored into the system. So the central banks have been raising the interest rates to bring inflation down. So the markets are fairly comfortable that inflation is getting under control. So therefore the market has gone up. And another example I could give you for this. So if you think back to a couple of years ago when COVID happened, so we're talking about March 2023, coming up to 3 years ago. When the COVID news started coming out in February 2020, the market dropped, and it dropped to the lowest point was, I think, 20th or 24th of March 2020. Now, after it hit that low point, the market rallied, the market went up. Now, bearing in mind, COVID was still there. It's still there now, but the stock market went up. And that was because the measures that had been put in terms of sanitizing, hand washing, social distancing, all of these things happened so that the markets could see that coronavirus was getting under control. And then, of course, the vaccines started coming out in October, November of 2020, but we didn't need to wait for the vaccines or for COVID to go away for the stock market to go up. So how it works is the stock market prices things in before. All the information that you're talking about, the stock market has known about it for quite some considerable time. That's all old news. Now they're focusing on things like earnings from companies. If the earnings are good, then if the earnings are good, the profits are good, then the share price should be going up.
Okay. Which is the best ISA for preserving or increasing capital value and may also provide income therefrom?
So yeah, with the ISAs, you can invest for capital growth, or you can invest for income. So if you've got a need for income, you'd follow an income strategy. If you've got no need for income, then you would follow a capital growth strategy. So the ISAs that I advise on are the St. James's Place ones. So we talk about investment ISAs where you should be looking to invest this money for 5 years to get returns on your money, because the markets will go up and down during the 5 years. Of course, the longer you can invest it for, the better your chances of making returns would be. So investment ISAs is good for where the time horizon is 5 years. If you're thinking about investing for short term, i.e. you need it for 6 months or a year's time, then I would recommend that you keep the money liquid in a cash ISA and not invest it into investment ISA at that point, because if you need access to the money, then that's going to be your primary consideration.
Thank you very much. Again, that was same question. That was a question from Nalini Ben Kotari. She's got a couple more. If one invests now in stocks and shares, ISAs, when FTSE is at highest, would it not mean that it would have to go even higher to increase the ISA capital value? So is it not best to invest in picking stocks when it's at the low value. Not so long ago, FTSE during COVID was about 5,000. Now increased to 60% to 3,000.
Yeah, so I would say it's always good if you can invest when the market. So what we look at is we look at investing over the medium term to long term. So although the value may seem high at the moment, 8,000, it's not actually that high. The value was 7,500 in 1999. So at that point, if you'd invested, if your money was just all exposed to the UK, then that would have been very good. But a lot of the other indexes, the American indexes, you will find that the FTSE 100 companies, they're not just UK listed companies. They're UK companies, but they've got overseas subsidiaries, overseas operations. So a lot of the income actually doesn't come just from the UK. It comes from the overseas income, overseas things. Now, the problem is when the market drops, people don't like to put their money in because it's volatile. Of course, if you invest, the market could drop, but if the market is happy and some good news comes out, then there's no reason why the market can't go above the current highs 8,000. If the other markets in the world are going up, then I'm sure the FTSE would also be going up. So we don't look at it and think it's high or low because we don't know what's going to happen next in the market. What we would say is you're better off investing it for a certain amount of time. Sometimes you might be able to buy things at a low price. Markets have dropped, you get the opportunity to buy. But most people don't like to buy things when the market is dropping because there's always a fear of how far it could drop. So I think the key thing is to make sure you're investing the money. If you're worried about the market dropping, you could invest some money now. So at least you're in the market, and you could invest some at a later date. So 3 months time, 6 months time, whatever you're thinking. So there's different ways of doing it. If you're worried that the market is high, you might also think about putting in regular contribution. It doesn't need to always be a lump sum. So when you put in regular contribution, you invest every month, you will benefit from pound cost averaging. So that means if the market goes down, of course, you're going to pick up more units for your money. And if the market goes up, you're going to pick up units at a slightly higher price. But overall, you're going to get an average. And as long as the price is above that average, you will make money. So it doesn't, from that point of view, it doesn't really make that much difference for whether we think it's high or low. It's difficult to tell whether that's the highest point or it's going to go higher or it's going to drop. So key thing is invest. If you're worried about it, investing a lump sum at the top of the market because the market could drop, I understand that. Then obviously you may want to consider investing on a monthly basis, and that will help to take some of the risk out as well.
And that goes to say that's why we would rely on someone like yourself to guide us on that side of things. And if you're managing our wealth, then that's an area that you would always be considering.
Correct. And the other thing I would also add is when the stock market goes up, I always say this to all the clients. The key thing is when the stock market goes up, don't get excited. And when the market goes down, do not panic as well. Because if you're investing for 5-10 years, of course the market is going to go up. Of course it's going to go down as well. But it's a case of making sure you're comfortable with the level of risk involved. So if we have a conversation with you and we identify that you're maybe a bit more cautious or you haven't done investments previously, then you're going to go for a more cautious type of portfolio. If you've had loads of experience, you've done lots of investments, you may be more comfortable with a higher level of risk. So that's where we work out what's going to be comfortable for you. At the end of the day, I want everyone to be able to sleep easy at night and not have to worry about things. Some people will want just a little bit of return, better than leaving in a bank account. And some people will be looking for more return. So whatever it is, we can find a solution and an answer for you.
Yeah, it's between bottom line and being cautious. So it's how that person wants to play it.
Correct. I think you have to take some risk because ultimately, if you leave your money in a bank account, you're also taking risk as well because of inflation. Inflation is a silent effect. You can't see it But you can certainly feel it when you go to shops. But your money in a bank account is also getting eroded. So just leaving it there. Sometimes people say, I don't want to take any risk, but I think well, if you're leaving in a bank account, you're also taking risk. It's just that it doesn't feel like it. You'll think your 100,000 is still 100,000, but in a year's time, the actual purchasing power of that 100 maybe 94,000 pounds.
Yeah. Okay, brilliant. Thank you very much. Next one from still with Nalini Kotari. And investing in property is no longer, and I think this is more of a statement than a question, an attraction with high loan interest rates and falling property prices.
Yeah, you've got all of those things happening exactly like you've described. Property is getting more and more difficult to make money, and the reasons are high cost of borrowing. So if the borrowing is high, then it's going to reduce the amount of profit you make. Then you've got the various changes in taxation. So on your rental, not on your profit, but you're paying tax on your rental income. So again, that's going to eat into your thing. You've also got property prices are very high. So most people don't always have 25-30% deposit because the price have gone up so much. People might have a smaller deposit, like 10-15%. Now, in the old days, 10-15% when the interest rates were low, you could actually make some money. But if nowadays, if you've got more than, if your loan to value is probably more than 60, 65, 70%, you may not make any money by the time you factor in void periods, by the time you factor in insurance, damage, interest rates, cost of borrowing very high. Of course, you've got stamp duty. So there's a lot of reasons why investing in property is becoming more and more difficult. And if you've already got property investments, you might be thinking, well, actually, we need to diversify the investments. We don't want everything linked to property, which will fall in value if the interest rates go up more. It's already falling in value at the moment.
Okay, brilliant. Thank you very much. Narendra is, what about the residence nil rate band?
So how it works is you've got nil rate band. Husband and wife will have £650,000 available. If it's a single person, the nil rate band is £325,000. As long as you've got a property and it's going to your children's step or adopted children, then your allowance will become £1 million. So you'll get the residence nil rate band. So for an individual, it's £175,000. So for an individual, they'll have total 500,000, 325 plus 175, and for a couple, they'll have an allowance of £1 million. Now, obviously, if your estate goes above £2 million, then the main residence nil rate band will start getting reduced. Now, you might not quite be at the £2 million point, but you might be not far off it. So we have to think what's going to happen over the next 10, 20, 30 years with property prices, with inflation. Some property prices will increase. Your debt might be getting repaid because of repayments. So therefore, your inheritance tax liability is going to increase as well. So yeah, a lot of different things to think about.
Okay, thank you very much, Narendra Bhai. Now, Nalini Kotari again really appears to invest in pensions pot. Is a property with the tax relief back to increase the pot and get 25% lump, some tax free upon draw time. Also, anyone even not working can invest. I think it's more again a statement.
So anyone not working can invest 2,880. The government will top it up by £720. That's essentially free money. So that would mean total 3,600 is going into your pension if you've got no earnings. Certainly that's worthwhile. And yeah, putting money into a pension is more than likely going to be the most tax efficient way of doing things. Okay,
yeah, and she just goes on to say pot increases by £780 takes. She's given guidance, advice, then a question. Interesting presentation. Is it possible to have a copy of the slides, Dipesh Bhai? I would answer that you keep watching over and over again. This is on YouTube. So you can go to YouTube and watch the slides over and over again if you missed out on anything. But if you want advice, you've got Dipesh Bhai's contact details there and his email. Email him or give him a call, and he'll happily answer any questions that you have. Is that okay, Dipesh Bhai?
Yeah, absolutely. I mean, of course, the more times you watch it on YouTube, that's good for my YouTube figures. More viewings is good. But in terms of actually solving the issue, sometimes because things are complicated, you can read things online, but you might be reading things out of date, or you don't know who's written those things. It could even apply to different countries. I was looking up something the other day, and I put it into Google. It brought up stuff, and then I read a little bit, and then I realized we're talking about something in a totally different country, which of course doesn't apply in the UK. So yeah, at the end of the day, I would say you're better off having a conversation with us. We can give you the advice, we can give you the information you need. We can help you understand these things, hopefully in a nice, easy way, without too much unnecessary, complicated jargon. I like to keep things simple, straightforward. There's already a lot of jargon in this industry.
Okay, totally agree with that. Like I said, the point of it is that information changes daily. So this may be relevant now, but after 5th of April, it may not be relevant, and things will have moved on. So, right, I hope that helps. So I don't know who this is. It says iPad. If you are not working, have some savings in building society, in ISA, and some years missed out on adding in ISA pot, and have some few other savings elsewhere. Now, any interest you from this account, is it counted as income, or is it only applies if you are employed?
So if the money is in an ISA, any income is going to be free from tax. If it's in a bank account and it's not an ISA, then that would be treated as a taxable income. Of course, you've got the personal savings allowance, where if you're a high rate taxpayer, you can earn £500 of interest without paying tax. So you need to have £20,000 in your bank account at the current rates. And if you're a basic rate taxpayer, you can earn £1,000 of interest, i.e., based on having £40,000 in your bank account. After that, you would need to pay tax. But then you've also got your personal allowance, £12,570.
Okay. But if you're a pensioner, you could still have money in your investments, which will cost you to pay tax as well. So
yeah, so if your money is in investments, it might be better to put it into an ISA to protect it from tax.
Okay. I think that's what he was kind of getting at. So I think the answer there is being more up to date with putting money into ISAs than having it lying in other accounts. But you can always get in touch with Dipesh Bhai to guide you in the right direction for that. Kokilaben Shah is putting into pension the best option, always changing in laws, your age, etc.
If you got an option, again, it's going to depend on your circumstances, when you need the money, whether you've got an inheritance tax issue that needs dealing with. But pensions, from a tax point of view, are one of the most tax efficient vehicles out there, one of the best vehicles you can invest your money in. At the moment, the rules are very generous, in the sense that any money in a pension, you can pass it on without paying any inheritance tax. So that's good. The treatment for 40% tax relief if you're a high rate taxpayer is great. They might make some changes in the future. They might reduce the amount of tax they allow you to claim. But certainly, whilst the benefits are available, I would say make use of it. So before the end of the tax year, what a lot of people will do is they'll put in a lump sum into their pension because the time is running out. It's a question of getting as much into the pension as possible. Or because then what people will also do from April, 6th of April, is actually put the money into on a monthly basis. Some people like monthly plus a lump sum. It's whatever's comfortable, but pension is a very good vehicle.
Okay, right. I think Jayshree Patel, Dipesh Bhai, is the lifetime allowance of just over 1 million at cost or value?
It's value. It's not based on how much you've invested. It's based on the value at the time, because obviously the value will go up and down.
Okay, that was an easy one. Is Bao, if saving in pension, how much maximum can we invest into pension? It's dependent on your
it's going to be dependent on your income. So let's say you've got sufficient income. If you haven't done any pension contributions in this current tax year, the maximum you could put in would be £40,000. Then what you can do is you can go back 3 previous tax years to 1920. You can put the £40,000 in if you've got earnings and lump sum available. Then you can do 2021, and then you can do 21, 2022. So by then, theoretically, you could put in £160,000 into a pension. But to do that, you need to have the earnings, and of course, you need to have the thing. But yeah, there is the opportunity to backdate pension contributions. It has to be the current year has to be done first. Then you have to go to the earliest of the 3 tax years, so 1920, and then you have to fill it in the subsequent order.
Okay. I was just going to add to that. Was that again? That's sorry, I'm just getting maximum how much we invest into pension. Right, next one, Shah, Ben Shah. Are your ISA managed, and how have they performed? Again, that's a personal conversation, I would presume.
Yeah, I mean the ISAs. If the market goes down, our ISAs will go down like anyone else's. Just depends on how much they go down, and that will depend on how the money is invested, where it's been invested. Right now, the last 2-3 months, it's been a good time for markets. Investments have gone up, so our ISAs have gone up. When we look at it against the benchmarks, we're doing well against the benchmarks. Obviously, no one can perform well in all scenarios because portfolios need different type of asset classes. But if you take a medium-term view, 5 years, 10 years, then yeah, they've performed better than the indexes, the benchmarks.
Okay. And sorry, I do have to apologize. It's Nalin Bhai Kotari, not Nalini Ben. Apologies. I have corrected myself. My eyesight wasn't that great. Right. Kamal Shah, the funds put in a pension is gross, i.e. no tax has been paid on this, and there could be tax implications. However, funds into ISA, you will have paid tax on these funds, but no tax implications or on any gains. Is that correct?
So how it works is with an ISA, they're free from capital gains, they're free from income tax. You don't get any tax advantage at the beginning like you do with the pension. Therefore, with the ISA, you're free to take it out. So whatever you put in, you can take it out. No problems. With a pension, when you're putting in an amount, that money is getting tax relief. So if you put in £8,000 as a basic rate taxpayer, they're pushing it up to £10,000. Now, later on in the future, you can take out 25% tax-free, up to 25% tax-free. But then any money that's left in the pension will then be subject to income tax, depending on your income tax bracket. Now, what some people do is if they've got enough other assets, they will not take the money out from the pension. They will actually leave the money in the pension and let that pass on to the children. So there are different tax advantages. Also, if you're taking this income, you might want to wait until your income tax position changes. So if you're from a 40% taxpayer, you become 20%, then you might want to wait until that point, because that's going to make more sense to do that. So again, we would say they're two different vehicles. There's room for both. So maybe in some circumstances, ISA might be better. So if you're 30 years old and you need the money in the next 5 to 10 years, then an ISA is going to be better, because a pension will not allow you to get the money before the age of 55.
Okay. Right. I think the Bow's question earlier on, when you mentioned 40,000, that's for a partner, a joint income of husband and wife. Where
no, nothing to do with joint income. It's to do with pensions and sole names. It's based on your sole income.
Okay. Right, so 40,000 was the correct figure. Rita Ben, can you please explain how you can pass what's in your pension to your children by saving inheritance tax?
Yeah. So what happens is with the pension, when you pass away, if you pass away before the age of 75, the money can go to your family members free of income tax or free from capital gains tax. If you die after 75, you've got to then pay income tax on the money. Now, when you pass away, the children, if it stays in as a dependence drawdown, then the money will stay in the pension, and therefore that will not be subject to inheritance tax.
Okay, hope that explains your question there. iPad again, how can you find out taxpayer payer you are, higher payer or less?
So if you earn more than £50,000, you'll be higher rate. Less than £50,000, you'll be a basic rate taxpayer.
Okay, request from me to everyone. If you've got questions and you want, it will be nice to have when you join, to change your name to your name instead of iPad or iPhone, so we can recognize who we're speaking to and who we're answering the question for, because it's not. It would be just to kind of be on the safe side that we are answering questions to someone that we know. So it would be easier to identify you. So if you can do that, that would be great. It's not always, if you don't know how to do it, ask a family member to help you change your name on your screen. Read again. I think I've asked this question. Rita Ben's kind of come up with a second. Can first salary pension be passed on to your children?
So how it works with final salary, it gives you a lot of benefits. So with final salary, it will increase in line with inflation. There's no risk. But the problem with final salary schemes is when you pass away, there could be a little bit of money for the spouse, so 50%. But when the spouse passes away, that final salary scheme will come to an end. So a final salary scheme itself cannot get passed over to your children. However, if the circumstances are correct, let's say, for example, you've got enough income, if you've got enough assets, obviously, if you need the income, then you've got to keep it in a final salary, because that doesn't go down. You're going to get a fixed amount of income. But if you've got enough income, enough assets, and you're not relying on the final salary, then what we can do is we can look at transferring from a final salary scheme. We have to assess the viability of transferring from a final salary scheme, so from a DB scheme into a DC scheme or a money purchase. Now, a DC scheme or a defined contribution can actually carry on and go to your children. You go to your children, your children's children, your children's children's children. So that's something we'd have to do. So obviously, final salaries are complex, so we have to make sure that the advice is suitable for you. So we'd have to understand your situation. So if you've got a final salary, I mean, you might have seen the values have gone up recently, just the transfer values, because the scheme would prefer to get members off the books because they're seen as a liability. Now, recently, you might have seen the values come down a little bit because of interest rates going up and inflation going up. So those are things that will have have an impact on the value of your final salary scheme. But if you're thinking you want to pass on this money to family members, then we need to look at whether it's possible or feasible to change it.
Okay. And that's on an individual basis, so it cannot give a generic answer for that. But it is possible to do that. That's
correct.
Okay. Again, then Bao is asking: does the government top up if I invest 40,000 in pensions for the previous years for 2020 to up to 23?
You always get the tax relief. Yeah.
Okay, and is that by year?
Per year, every year you'll get the tax relief. So 20% is given to you straight away, and the balance 20% you claim it through your self-assessment for 40% taxpayers.
Okay, right, and I think the last one we've got for tonight is from Mitaben. How do you pass second property to your children? Sell property and give proceeds without incurring massive CGT.
So how do you do it without massive capital gains tax liability? So first of all, so if you transfer directly to your children, you dispose or you do anything like that where you transfer to your children, then there's going to be a capital gains tax liability. So the only way to have no capital gains tax liability is to defer the capital gains tax liability. So, for example, when if you put it into a trust, for example, then there'd be no capital gains tax liability. But you've got to also make sure that you don't need access to the money, because you can't give it into a trust and continue to take the rental income. If you're sure you're comfortable that you don't need the rental income, then you can put that property into trust. The rental income will go into a trust for the benefit of the beneficiaries. So you can't take that rental income and use it just for your own benefit.
Oh, so that will occur in the account, in the trust.
Yeah, you'd put the property into a trust, and you would need a trust bank account.
Okay, brilliant. Right, I think that quite a few people have that in their minds, because that question's been asked before. I think that was the last question that we had for tonight. So questions, Hoy. I'm just going to quickly ask the audience. I'm going to say good night to YouTube first. To YouTube, thank you very much for anyone on YouTube. Thank you for joining today. I hope you found the talk interesting. It's opened eyes for a lot of our audience today. Baz also kind of got some questions, but we'll speak to Dipesh Bhai on privately on that. But thank you very much for taking part. Don't forget to subscribe, thumbs up, and ring the bell for notifications. Subscribing is very, very important. If you like this video, give it a thumbs up and leave a comment, because that gives Dipesh Bhai a lot of increment on his known on the chat, and so we can share it on his channel as well. So thank you very much for joining us tonight. We will see you very, very